Hedgeye's Cyber Monday sale is here. This is the best deal we offer anytime on our investment research. Since 2008, Hedgeye's 40-plus analyst team has helped investors big and small navigate volatile financial markets. Now, let Hedgeye help you. Our special Cyber Monday sale features steep discounts on all of our industry-leading investment research. Explore our range of products that can suit your specific research needs. Don't miss Cyber Monday at Hedgeye.
Good morning, I'm Daryl Jones, Director of Research at Hedgeye, and welcome to the Outlook, which is an update from my colleague and our CEO, Keith McCullough's view of what's going to be happening over the next quarter and shorter term and maybe even a little longer term. It's going to be about 20 to 25 minutes, and then we'll get into Q&A at the end of it. So with that, I'll hand it off to Keith.
Thank you, Jonesy, and welcome, and thanks for making some time in your busy day to join us. We are now getting through we're through the first month of the fourth quarter, and our big call back on September 23rd, which I'm going to update. Again, all this data continuously updates, so it's not stale data. Again, it's the same view, which is quad 2 in Q4. Again, we're 1 month into that. Quad 2 in Q4, I'll explain that. That's the theme that we're going to be rolling with here today. First, though, I want to spend a couple minutes on process for those of you that are new to what we do or want to know how we make these calls. It's not like I'm Nostradamus or anything like that. There's no politics to it. It's apolitical and it's data-driven. We focus on the rates of change. So if you jump right into it, guys, on slide 5, it's the rates of change. It's the secret to the universe. Many of you know that to be calculus. So again, we focus on math, historical time series, and behavioral psychology overlays as opposed to anchoring on it's different this time. Are you feeling something when I speak? I trigger some people. It's okay. It really is okay. I mean, valuation is not a catalyst. Let's just start with that. And your feelings have nothing to do with what makes the economy and or markets that are reflecting on economic realities go up or down. So again, we want to focus on what is the rate of change sequentially and year over year, which is something obviously that we can measure and map readily through the lens of the quads. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. So on slide 6, you can see the quads. What are the quads? Well, the quads are 4 economic scenarios. Currently, we have us in quad 2, where you have both growth and inflation accelerating at the same time. Hashtag quad 2. The opposite of that would be what the call that we made back on January the 30th of 2020, ahead of the pandemic, knowing nothing about the pandemic, that the economy was going into quad 4. Quad 4 is when you have the opposite of that. You have growth and inflation slowing at the same time, or deflation. Quad 1 is Goldilocks, and then quad 3 is stagflation. Again, you're using growth and inflation on a trending basis year over year. So again, we're coming out of quad 3. We had a quad 3 view and set up in the third quarter, so we call that quad 3 in Q3, and we call it quad 2 in Q4. A lot of people are missing this, and we'll show you why. By the way, before I show you that, I'll just show you why we use the quads. The back tests, next slide, there are probably too many numbers here, so we'll spend less than 2 seconds on that. Go to the next one. The words behind that, again, show you what you do in each quad by asset class, okay, by sector style, by factor exposure, only brought to you here by Hedgeye Risk Management. Commodities, obviously a massive asset allocation for us in both quad 3 and quad 2, so we've been riding our long commodities asset allocation since June of 2020. That's June of 2020, not June of 2021, June of 2020. And again, when you flip from quad 3 to quad 2, you do things like go from long gold in quad 3 to short gold in quad 2, and you're not triggered. You can handle this. You can do this. Again, risk managing, real rates rising. So again, what happens in quad 2 is you get a breakout in interest rates on both the short end and the long end of the curve. So we're not surprised one iota about what's happened in 2-year bond yields in the U.S. or globally for that matter, particularly on the European side, because we also have them in quad 2. So we'll go through the global quads as well. So you get a breakout in bond yields. You get a breakout in everything from consumer discretionary stocks to tech stocks, energy stocks, financials. Those are 4 of the top 5, as you can see there on your sectors. Just on signal, don't forget that you need a signal to front run these economic realities and or to confirm or deny your positioning, and I don't particularly care what my position is. I'd prefer it to be right, but again, being long or short, that is, I go both ways and I like it. Yeah, a lot. Trades, trends, and tails, okay? Trades, 3 weeks or less. Trends, 3 months or more. And of course, long-term tail risk to me is inside of 3 years. I've never made a call beyond that. So again, I don't make calls again. I'm executing on the process. Slide 10, factor exposures fully loaded with net positioning of the market. So finally, the markets come to us. They're starting to get longer of S&P 500 and shorter of bonds as opposed to where they were when we made this, this call a while ago. They were long bonds, long dollars, and short stocks. They're still short small cap stocks. We're long small cap stocks in quad 2. Small cap, higher leverage, high short interest. That's back on slide. You can go back on slide 8 and review all that on your own time. But again, what is the data actually doing? So now let's just get into why. So why? We don't particularly care so much about the why. It's more about when. So if you jump to slide 13, our current nowcast for the U.S. economy have the economy accelerating from 5.17%. And again, this is all updated for real-time data. I'll show you what that looks like. Actually, just flip it to slide 16. All these data points are rolling through. We have 30 data points per month in the model. Again, it's our model, proprietary. Nobody else has it. So again, when you look at it this way, it's really easy, really. You just update it, And so at the end of the day, you get 90 data points or 90 opportunities throughout the quarter, 30 data points per month to update your view. Again, it's not a feeling. It's not what the world should or could look like. I don't theorize. I'm not an intellect. Again, I'm just executing, again, in some cases, ruthlessly on this data-driven approach. So what it ends up giving you is this acceleration currently. And again, our quad 3 and Q3, that's a real growth slowing environment. That's stagflation. We were talking about stagflation well before it became popular, kind of media type headline. But if you go back to slide 13, all that means, just to make this really simple, is going from 5.17% to 5.77%. That in GDP terms is actually quite a bit of an acceleration. What you'll find at the prior peak of the cycle, 3.3%, first of all, that's a lot higher than that, almost by a double. And secondly, the Atlanta Fed, which is that red bar, or the consensus econs, have all taken down their numbers big time, way too low. So if you look at it the way that Wall Street does, on the next slide, which is a real GDP quarter-over-quarter SAR. Yeah, that's a mouthful, and you don't want to repeat it. So they're at 0.53. You can barely see it. See how that Atlanta Fed, it's red, Q3, go to that column. We have it accelerating to 6.77% sequentially. So when I said sequentially versus year over year, that's going from the quarter we just slowed into, which everyone knows about. I think everybody knows about. Slide 44, we're going to show you why. Why? What happened there? Why did everybody get so bearish? Oh, the variant. So there are variant narratives about this, but this is a really easy one to understand. Okay, even I can get this right. Which is, again, the Delta came in, so you see COVID case counts ripped. They went, rate of change positive, obviously, throughout the summer, and then just absolutely ripped, unfortunately, into August. And the whole bloody economy slowed. So you had consumer confidence slow, you had hiring slow, you had 2 bad jobs reports, service sector economy slow, hashtag slowed. My buddy McCullough would call that red lights, not green lights. Now we're starting to see the green lights. Slide 58, guys. We're going to go to the conclusion of this, and then I'll bring it right back to you. I'm not going to play the bongos naked, though. That's for a different kind of an Irish guy, McConaughey. Great book, Green Lights. Don't overthink it yet. COVID cases are going down. Hiring is now going. We think the jobs report this week is going to be the first quad 2 jobs report in Q4 because it's Q4. Service sector activity going up. We already had that in the ISM services number, actually even last month, which was the September number, which was surprisingly bullish even to us, given that you still had that lingering variant, whether it be narratives or the COVID cases themselves. And of course, quad 2 probability continues to go higher. Now let's just do the inflation thing. Actually, one more time, slide 14, just to review what we just showed you. So this is a massive, like the Atlanta Fed has to take their numbers up, way up throughout the next 3 months. And all you're going to read about is Wall Street repeating that. And this is after Morgan Stanley took down their numbers, Goldman took down their numbers, Atlanta Fed took down their numbers. They took them down after they slowed. That's not how to do this. No. The bond market's got it right, of course. Bond market breaking out to new highs. Bond yields are, and we think they will get right back to where they were, or at least cycle highs, back to where they peaked prior when we were in quad 2. Don't forget, in quad 3, bond yields go down, yield curve compresses, people get nervous, and then you get this big hookup in short-term yields, which we've also had. So to get back towards 6-7% GDP, that's going to be a sight to see. Now, on inflation, slide 15, our nowcast, which At the beginning of the year, we're basically like a double over the Fed's view. Now the Fed's catching up. It'd be hard not to. It's like observations of the ragingly obvious. Ragingly rate of change, obvious that being. So you went from 1.9 to 4.85 to 5.34 in the current quarter, and we have them accelerating a little bit on that chart to 537. But if we front run our own model, yeah, we can do that. I'm going to show you how. I'm going to take a third of the number, which is the roof over your head or shelter and rent, and that number is most likely going to be closer to 6 or north of 6 in the fourth quarter. So again, to review, quad 2 is when growth and inflation are accelerating at the same time, which is that to the people that are long of duration, deflation. If you really think about how bearish they are, they went to cash in September at the VIX at 28. That was the damnedest thing. The VIX was at 28. It gave you one more chance to buy the living daylights out of the stock market before it hit the 36th all-time high in the NASDAQ Friday. 59th all-time closing high this year for the S&P 500. You had a wonderful opportunity with the VIX a lot higher to be allocating your hard-earned capital into the right economic conditions as opposed to being old wall. You don't want to do that and go with the feelings and the emotions and my 10 to 12% correction call, which has been wrong all year, is going to be 20. No. That's not how you do this. That's not how you do this. We want you to play the game like pros. All right, what else do I want to show you? How about the quads are global? Now, where did you hear that first? And the measuring and mapping of it all. Obviously, that's all built proprietary here at Hedgeye. So you can see the quads are global. So it's not just the U.S. in quad 2. If you go to the Q4 column, you'll find, and we're not perma-bulls. No. We have red lights in places like China, South Korea. I mean, we're the first firm to go bearish on China in the first quarter of this year. Still bearish on South Korea. We're bearish on different parts of the world, but that is not Europe, and it certainly is not the USA. So again, and by the way, the lights change, and that's the whole point. The signals front run the changes of the coloring of the lights, and that's very obvious picture as the green lights are coming back on the page. Slide 22, how do you use this? So whether it be like German bond yields breaking out to new cycle highs, well, what quad does that happen in? So we look at the page there, it says the German GIP model, that's the quads, growth inflation policy, front-running policy makers is what we want to do. And you get to the quad 2, see the quad 2 where the expected value of the bond yield goes up only in one of 4 quads? See how that black bar is positive expected value? Every other quad, bond yields go down. So why would you be long German government bonds or be in cash? I mean, it's ridiculous, right? Just absurd. Now China, if you had a quad 3 stagflation, no, the real nasty stagflation's in China. Kyle Bass and I had a good chat about that. Now, there's only one, the worst place to be, see how that expected value on the right chart in quad 3 is the most negative for China in quad 3? So everyone in the world, if they knew how to run money the right way using the quads, that's the right way. That's a better way. It's just a better process. You would have not been long China, and you certainly wouldn't have missed this move in European bond yields. Voila, mes amis. All right, I also speak a couple languages. The quads are global. As you see here, emerging markets, the green lights are starting to go on. 6 emerging markets we're currently bullish on against the China short, which is great. So again, we recently, on September 23rd during this presentation, added India. I want you to show that slide 114 just to make sure everybody's got all 6 of them, Eric. And I rarely call him Eric, so this is getting serious here. We're talking about the top 6 emerging market asset allocations that we have. India looks fantastic. Obviously, Israel hitting new highs. Are you long Israel? Why aren't you long Israel? Are you still debating whether or not you should be looking for a correction in the Dow and points? I mean, come on, you got to get up to speed here. This is global macro, where we actually do global macro. Okay, so there's a lot going on there. Israel has been fantastic. Indonesia's been great too. Thailand's been correcting. If you want to buy yourself or your family office some of that, I got no problem with that because I'm long all that stuff. Slide 26, what are the themes? We have these 3 themes. We're only going through number 1, although I have somehow found my way to rant into the other things, just because that's what I do. I mean, I don't have a teleprompter, so that's apologies for screwing that part of this up. Slide 27, we start everything with a cartoon in a current theme. Bob Rich is, according to me, the best cartoonist on the earth because he's a Hedgeye nation. He's a partner in Hedgeye. I love that. Let's just do it. Instead of the cartoons, let's use some words. It doesn't say transitory. Never in my career, I've been doing this for a long, long time, over 20 years, have I used the word transitory. Nope. I use trending. Things trend, and you want to be long bullish trends, and you want to be short bearish trends. Short China, long inflation. So inflation, same quarter, new quarter, whatever, same adjectives. Sticky, high, not like transitory, whatever. Doesn't matter what they said. It doesn't matter. If you didn't make money on that, too bad. If you did, then well done. The CPI peaked. Some people were looking for this to peak in the third quarter, but it really didn't when you look at it, next slide, on a 2-year look back. So that would include, a lot of the structural effects that aren't just pandemic base effects. Now, if that's a word scrabble for you, again, we don't have enough time to unscrabble them all. There was a time when Hedgeye would be the only one talking about base effects and what the rate of change of the economy was going to do. Now it's a little bit more common because people like to borrow our stuff, or in some cases steal it. And, it's still the same thing, but they're not really all that good at understanding how to use the bloody thing, right? So we didn't see a peak in inflation. In fact, underlying inflation, which the Fed likes to say, because there's never really been this kind of an inflation in the modern era. So if you look at that right side, so they'd say, well, if you look at underlying or you look at the median, there's really no inflation. Bullshit, right? So there you go. So if you look at the chart on the right, it really wouldn't get above 2 going back to 2000 and like a decade, almost a decade here. But it definitely got above 2 now. It's top shelf where grandma keeps the cookies. Yeah, look at that. And the median is too. Now PPI hasn't peaked yet. You guys got PPIs at home? Look at that. Look at that. PPI. You have a Halloween party last night? Go take a little PPI? Look, that hasn't peaked. No. That'd be a red light, right? And the PPI leads the CPI. Yeah, so we're expecting higher CPI. I'll show you why. September services prices, sorry, no peak. It's on slide 33. We color-coded that because and how about if you look at inflation expectations, if you ask actual human beings, what are they expecting on slide 34? 3 years ahead? Nope. Ripping. All right, no peak in transport inflation, slide 35. Freight costs, frightening. Absolutely frightening. Scary. Transport pressure is leaking through to labor prices. Now, I tweeted something about this weekend. This truck driver wrote a wonderful piece on this to a degree on the ports and what the dynamic situation is in terms of ports and how a trucker gets in and out of the port. So I thought that was really interesting because it augments, obviously, what we've been telling people since September the 23rd, which a principal contributor to this, in addition to what he wrote, is that there's a shortage of truck drivers, okay? There's a shortage of truck drivers and people to get these inventories that everybody wants into and out of warehouses, okay? So you get some labor inflation is about the easiest thing to see at this point, but these things are gonna magically come unglued. And as they do come unglued, it's positive for what? Quad 2. If you take the inventory that's stuck and you put it into the economy and it sells, the GDP goes up. Yeah. Yep. Surely the Fed can finagle something like this. Look at this. I love this. This is the Fed's own Nowcast. Now they have their own Nowcast. But you have, for a while, and even some of these other more conflicted and compromised types, like Brian Deese at whatever seat he has for the Biden administration. And no, I'm not anti-Biden and whatever. It's just that their own Nowcasts are saying the same bloody thing at this point, and everybody sees that. Now, how about rent inflation? Now, this is the biggest component of what's really driving our Nowcast for Quad 2 higher on the inflation front. No soup for you. I mean, rent price appreciation here and expectations of further, rental gouging. This is, again, a New York Fed survey, okay? They knew it. They just didn't want to talk about it. So we're just going to keep showing you this chart. Now, longtime subscribers of Hedgeye love this chart. And people that have only been with me for a year and a half love this chart. This is on slide 39. We're just going to keep showing it to you. So again, shelter, CPI, for most human beings, is a major thing. It's a third of the CPI, so a third, 33%. Now, here's where we're at, and here's where we're going. With 100% certainty. 100? This is like billions. How certain are you, Keith? Very certain, all right? And again, look at this slide 40. So the leading indicator for that is home prices. Not a huge conceptual leap there. But again, national home prices are now updated as of last week's chart, which was another data point, like we drop it into the Nowcast, 30 data points per month, up now 20% year over year instead of 18.6. So this thing's just ripping. So if you draw your eyes to the black line, the gray line is what's going to be reported after that. That's called this U.S. government thing called owner's equivalent rent. So again, that's the point. If I take those numbers up to where they've already gone, you're going to have north of 6% headline inflation. The Fed knows this. Now, before they started day trading and doing all that, the guys in the Dallas Fed office, slide 41, they did this nice little white paper. Right? This is kind of, when it gets to the Fed, this is kind of like funny, but it's not. But they actually did. We've only been doing it like for 14 years at Hedgeye, telling people that home prices lead rent inflation. Everybody knows that does rate of change math, that understands, again, back to my triangles on slide 5, history, the history of it all, the math, the behavioral nature of it, how people, again, react to that type of thing. Oh, they got to find a place to stay because they're getting concerned that it's going to be even more expensive when they look in 3 months. Okay, so that's all behavioral. But slide 41 is just a reminder. The Fed just did what we did, and they're actually looking at 7, 8, 9% is a third of the CPI pending. Well, here's a little update on that. My friend Rosie, a good Canadian guy, had a real conversation with me on Hedgeye TV about. Well, he said, well, you can't see it in rent. I said, that doesn't sound right because. We do like all this rate of change stuff, and it's all color-coded so I can even see it. Slide 42. It's easy to forecast when it's already happening, Rosie. So what we did here is we took apartment rental growth rates. See on the right side there? Those are year-over-year numbers. For those of you that live and are renting in Tampa, Florida, when I first said this thing, Rosie, it's like up 25%. This is like in July. Now it's up 34.4, man. Evidently, he's still staying in Canada. Now, this is just ripping. And it's ripping in places where people want to move because they don't want to pay California taxes. Green lights, if you're the landlord. All right, so that's what that is. And I still can't for the life of me understand how some people, more traditional economists on slide 43, have poo-pooed this. Sticky high, like, do you know what the 100th percentile of historical readings are on a 5-year look-back means? So I used everything there on the left side that more traditional economists would use, and I get poo-pooed sometimes for not being a typical economist, but I have an econ degree from Yale. Oh, and I wouldn't do like a lot of the things I was taught there. Just stay with the real-time data. You're going to get a lot more things right. So that is what it is. Now, we already highlighted the most important slide there on what slowed the economy, slide 44. Just take another peek at that. And just take another peek at the peak in the delta, which is on slide 45. So that rolled over. This was already rolling over when we made this call on September the 23rd. Now it's down about 50% in a month. In Japan, it's down over 90% in a month, COVID case count. So that's important. Now, what we're going to continue to have on the other side of all this, or amidst all this, is labor market inflation. Slide 49. Guys, so that's that we don't see that abating anytime soon. What we do think is going to happen, so again, companies are going to have to pay for that higher cost of labor. So the people that are getting paid are going to have more money to do what? Consume more things, do more things. Have you been to an NFL tailgate lately? Have you been outside of your New York City apartment, navel gazers of New York, who are like, oh, this economy's never going to reopen? Where are you? Like, what are you doing? And why do you think your own experience in the world can be, stochastically modeled like we do it here into economic outcomes? That's silly, right? That's really selfish. That's what navel gazing is. You're just looking. I used to say that on CNBC, and the producers or wherever they were, the guys, they'd say, you got to stop doing that. You're offending people. I said, no, well, I'm not offending them. That's what they do. They look at the Dow and points. They navel gaze. All right? This is labor supply shocks in the queue, this next one, okay? So this is on slide 51. So we do think that we're currently on jobless claims, which is on the left side. We're at new cycle lows, okay? New cycle lows. This isn't mid-cycle, Mike. This is a new cycle low in the queue. So again, we have new cycle highs in commodity inflation, or commodity returns, which is more important. Selfishly, we're long all that stuff, right? So just keep this in mind as we go into Friday's jobs report, that the bond market has this right. They're going to keep taking the short end of bond yields up, the long end of bond yields up, and people are going to keep writing about different things about the curve. Earmuffs, just stay with quad 2. All right, income, and some people are like, well, when the benefits roll off, everyone's screwed. I don't think anybody on Wall Street ever had benefits. I mean, maybe they did, and it doesn't matter. Slide 52, I grew up in my dad was a firefighter. I got plenty of respect for people that live on tight budgets. I never had UI benefits, but look, there are other things that people got. Like in July, on the right side, you can see child tax credit payments started. That's a shitload of cash. Cash is king. Now, look at the cash in American bank accounts. And again, this is one of the most bullish things I can show you. Slide 53. It's misunderstood by all bears. This doesn't do this because Americans want to save. This is an incremental $4 trillion US dollars, okay? Now, US dollar isn't what it used to be. In fact, against Bitcoin, it's down 52% in the last month. And we're long of Bitcoin and ETH and all sorts of stuff that I don't understand. But I do understand this. Americans will spend. They don't want to save like that. So look at the chart on the right. During the last financial crisis, this spiked. And then guess what happened for the next decade after that? Americans spent their cash, right? Now they like to buy all sorts of stuff. Cars, pot, legal. It's legal now. You can buy booze, whatever you want to buy, they're going to buy, all right? So now look at this, trips, slide 54. The things that they couldn't buy, like there's a lot of inventory, these inventories. So I've actually thought of inventory and the supply chain bottlenecks as a super bullish catalyst for the economy, because these things are quite literally holding that chart on the right like a ball underwater. When it releases, it only has one way to go, and you better not have your face in front of the ball in a swimming pool. Been there, done that, right? So this is what's happening. And it's happening in autos specifically. U.S. Steel said this next chart, and this is one of the most important charts why I'm long Ford still. I was selling some the other day, but that's not the point. Why'd I buy Ford, when you should have bought Ford, which is before this most recent move? Well, because this chart had nowhere and has nowhere to go but up. This is down 88% from normalized levels. And everybody knows why. When a journalist on CNBC can tell you why, everybody knows why. Okay? So this is going up. U.S. Steel said our largest auto customers are now they've seen the trough, and now they're starting to build inventories. You got that? Again, really simple concept, okay? The inventory that didn't print in GDP when the economy was slowing during Q3 is coming back. And that is additive. And again, if anything, I think that I'm too low on our Wall Street high growth estimate for the fourth quarter. And a lot of it has to do with that. Inventories being released. They don't all have to be released. In fact, if they don't, it's more bullish for what? Sometime down the line in Q1. Okay? So again, the market's very good at seeing through this, and obviously people's bullshit on the topic. This, by the way, today's supply constraints are tomorrow's amplifier. This is a very basic relationship that all traditional even economists should understand. Old wall, fully loaded. Inventories, which is the gray line, chase the backlog. The backlog's the demand. That's where the black line is. There's a shitload of demand. It's not this isn't fake news. This doesn't look like anything other than what the market's already telling you. So that's another way to look at the gray line's going to catch up. And how fast it catches up, I don't care. Don't overthink it. All right, on slide 58, I already showed you this, but I'm going to say it again. And one highlight, in addition to that, is that the main line of the U.S. economic acceleration, or the reopening, you want to call it reopening, reacceleration, it's all quad 2, is the bottom line on the right chart. That's called services consumption. That's the biggest component of the U.S. economy that we're talking about when you're going to go buy a bag of beers and go buy a Patriots ticket or whatever you're going to do. That's the services economy. That's consuming goods, okay, that aren't the durable goods that are already ripped. Everybody knows that. Everybody's got their barbecue and whatever they're doing. It's the service economy, stupid, okay? So again, there's a lot more upside to that because humans do things on a non-linear basis. They're not linear like my old Yale models, okay? So again, think about that, and hopefully you enjoyed some of my bad jokes and you have some good questions.
Okay, we'll get into the queue here. Number one, questions from Josh in Bristol, UK. How is the current Quad 2 different from Quad 2 in the fourth quarter of last year and then the first quarter of this year?
Well, they're all different. They're always different. I mean, that's the thing about nonlinearity. Cycles cycle, but they cycle to different places. So if we go, guys, can you put up slide 13 again? I can draw on this a little bit. This is, okay, so Jonesy, this is, when our Quad 2 in November was also a review, I thought that was one of the best calls we've ever made. So again, when you had this one from basically the economy bottomed here, that's a rate of change bottom. That's where we bought commodities. But and then it took the economy a while. It was kind of like trying to figure out quad 2 or quad 3 here. But coming out of the fourth quarter, market signals really said, okay, look, I'm ready to go here and here. Now this, from up 0.5% to up 12.2% in the second quarter, is the fastest rate of change acceleration in modern history, and most likely to be the best you'll ever see. So again, all the things that work in quad 2, which include high short interest stocks getting squeezed, GameStop, everything that went bananas to the upside. And then you had the rate of change slowdown, which was towards 5%. That's a lot, from 12 to 5. Look at what the prior, very pertinent to your question. This slowdown was from 3.3 to 2.3. This slowdown was from 12.3 to 5.2. All right? So it was also one of the biggest rate of change slowdowns. This is why Wall Street got bearish after the fact. All right? So again, and then going back up to 5.7%. So maybe I should have doodled on it the first time, but it's always different this time. When it comes, every cycle's different. So again, and every country's cycles are different. Japan's, you can barely see the economic accelerations when they have them because they're just unbelievably bad demographics. We have a millennial generation. We have some of the best demographics in the world. So our consumption curves have a lot more upside when they accelerate.
Okay, question from Drew in Kalamazoo.
Kalamazoo,
yeah.
They still got a minor hockey league team there?
I think they do, yeah. Keith, are you concerned about inflation / cost of living eating into your bullish XLY call in quad 2? Thanks. Or how do you think about that aspect?
Not yet. I mean, it's if the numbers weren't going up, at some point I will. It's an interesting question. It's not a new one, but it's, everyone who said that inflation was transitory, we don't have it. So they're like, well, you can't really be long inflation. It's not investable. That has to be one of the most asinine things I heard all year. Now that I didn't know it was coming, now that's the problem, okay? Think about that. Why don't we just stay with the team that's had it right the whole way, and understand that this reopening with all that cash that I just walked through, for the period that I am long of quad 2, and that's all I selfishly care about. I'm not trying to solve for the world's political problems, low-income earners' problems. It's a real travesty that what's happening to them in their, what we call their key cost centers, which would include obviously the food on their table, the rent, medical, and gas, just ripping. But again, they don't represent the ballast of U.S. consumption growth. People with money do. And even the people that didn't have money now. So again, this is not a story I need to keep going circular and telling you stories about. It all gets down to what my numbers are doing. That's what I do. I don't do what something in my head says could happen, and that can be bad. And by the way, not my first rodeo in being bullish or going bearish, and I will go bearish. And at some point next year, the economy is going to slow, we think, by the second quarter of next year, so timing matters. Then, if all these core cost centers for lower to middle income earners, then you're eating into it when the economy is slowing. When the economy is slowing, that's stagflation. When the economy is accelerating, it's a party, in market terms.
Okay. James from Mass. In each of the quads asset allocation, is there a quad regime that the value equity style is superior? Or I guess said another way, when does value perform the best?
Value really likes quad 1 and quad 2. Depends on what you define. Value is it's like chasing a rabbit. You got to see what's currently being long energy, which is clearly value, has been fantastic. Something like commodities, obviously related to any equity position that we've had, has been, doubly fantastic or something like that.
Okay. How do you think about quad 2 with the Fed potentially tightening? Does that change your outlook?
Yeah, well, the market's already tightening for the Fed. I mean, so again, in quad 2, the Fed can tighten and has tightened. 2013, the year 2013, the year 2017. Currently, the bond market's tightening for the Fed. The Fed doesn't tighten and then rates go up. Rates go up and then the Fed goes, oh shit, I gotta agree with that. And so I think a lot of people get it backwards. They're just like, well, I gotta wait for the Fed to tell me when to rate. No. When the Fed raised rates in Q4 of 2018, when we made a quad 4 call, we said they were going to raise rates into a slowdown, into this, right? Nailed that too. That's when we bought gold, back in Q4 of 2018. For those of you that are just so angry about me being short gold right now, it's okay. Anger and love, it's what drives the world. Imagine Twitter without anger and love, right? So we got this. When the Fed is tightening into a slowdown like Jay Powell did in Q4 of 2018, shit hit the fan big time. He was on the linoleum floor like in the fetal position and going dovish just after Christmas. All right? Now, if they raise rates into what we think is going to happen in Q2 of next year, where we're going to be making a quad 4 call again, if they raise rates in March, very bad idea, Jay. I don't even know if Jay's going to still be around, but that might be a worse idea than you and your buddies trading all the time. I mean, that very bad idea. So again, raise rates during an acceleration because you're allowed to. The market will let you do it. Yeah. And if you raise rates into a slowdown, you are the catalyst for nasty, nasty market declines.
Okay, when the U.S. eventually goes to quad 4, do other country quads become less relevant due to contagion or the fact that everything's sort of tied, or a lot of things are tied to the U.S.?
Yeah, I mean, well, just to use a very obvious example, when China's in quad 3, you don't have to make a global contagion call. Like, that's not what we did. In fact, when the VIX hit 28, you look at a couple of those. The thing about the bear market narrative, the correction is coming narratives, is they try to find something new all the time, right? So it was like, oh, we're going to default on our debt, or we're going to have Lehman Part 2 over here with Evergrande. No. If China's in quad 3, fucking short China. That's it. If the USA is in quad 2, you buy the USA against your China short. This is why I'm actually quite surprised that there aren't some bigger hedge fund returns out there on the macro side, because there have been some monster calls out there this year. To stay short China and Hong Kong for that matter, and then add South Korea, and then on the long book go with India, Indonesia, USA on the quad on the quad 2. On the quad 2, you're long Qs, you're long XLY last week. Those aren't like, these are big positions. These aren't like little things. So again, be careful with the narratives. Start with numbers and then tell yourself a story after the numbers are leading you there. The other way to do it, that's why we're so hard on this macro tourism. Not so much because we don't like people or I'm a mean guy. I handed out a lot of treats last night and I didn't look scary. Right? I'm not a mean guy. I just don't want people to lose their money going to cash when they should be buying the stock market. That's terrible, right? So we have to be critical of these storytellers, comme raconteurs en français. Everybody wants to hear a story. But all you're doing really with that is either, at a minimum, losing an opportunity to make money, or saving money in the case that people are telling stories about how the market can't go down when it's about to go down, which would be a much better story, is that it's actually true. And then you don't waste so much time. Don't forget that all these people, they're getting paid clickbait dollars, advertising dollars, for you to pay attention to all this stuff. But you're going to waste a lot of your precious lifetime doing that. I call it cycle time, whatever, God willing, I have left on this good earth. I'm not going to waste my time reading their narratives or listening to them. I got too many other things to do, Jonesy.
All right, we are going to wrap it up there. Thanks, everybody, for tuning in. Take care.